It is my pleasure this morning to introduce your next speaker. But I did speak with this gentleman last night, and he told me that he did not need any introductions. That, if you want to remember him, he is the man that can give you money. But I think I'm going to just give you bullet points. Well, he is with Live Oak. He has been with Live Oak since 2016. He actually did go to school. He earned his BA at Wake Forest University and his JD at the University of Baltimore School of Law. His current position with Live Oak is a senior loan officer. So he is capable of giving you guys money. So please help me to welcome Mr. Mackey Hughes.
Morning. Okay, so we did something a little bit more tailored to what John wanted to do, sort of a state of the industry. A lot of times we'll go through loan products, leverage, all that. We'll touch on that. But as of last month, and then a couple other things, we get sort of a few little metrics for each state and also nationwide through ASHA and NIC maps. And so we sourced a lot of that, and a lot of that is current information. So halfway through 2025, and you'll see all that. So again, Mackey Hughes with Live Oak. So next. And these are sort of the topics we're going to talk about today. And then we'll get into some Q&A later. So let's hit the next one. All right, so just a little bit about the bank. It's a little bit of a unique bank. We started right around 2008, so not the best time to start a bank, but kind of grew in the world of SBA and fintech, cloud-based banking, and all that fun stuff. So basically, the idea was we were going to make a process that was arduous a lot faster. We continue to improve to do that over these years, and we've been top USDA, SBA lender here and there over the past 10 years. And, we're doing tons of volume, continue to do that, and treat every customer, grounded customer, sort of our motto. Again, number one SBA lender, I did that. So let's talk about banking in Texas. So this is since 2001, and except for that one point, we did over 12 locations this year, or loans this year in Texas, but this goes back with all these other banks. And this is all for seniors housing, right? Assisted living, memory care. So Live Oak is obviously, we're very bullish on it. We love it, we understand it, we built a team around it, all the way from originating the loans, underwriting loans, decisioning the loans, servicing the loans, construction, closing, all of our teams are kind of geared towards each sector that we have at the bank, and obviously senior housing is our sector, and we've done quite a bit, a lot of approvals. Wallace Bank in Texas would be the second, but they hadn't done a deal since 2023. That's not uncommon for a lot of banks right now. They don't necessarily understand this sort of the sector of senior housing. It's weird to underwrite it, especially when our operator senior housing is, kind of the Wild West when it comes to a lot of underwriting. And then a lot of banks have had stuff on the books where they're kind of satiated with senior housing or any sort of healthcare or real estate. And so you'll see, banks like us that have capacity to continue to lend and sort of pick up the slack from other banks. And we're excited to keep doing that. Yeah.
You guys know 504?
No, we do plenty of 504.
Oh, I guess I saw the part.
Yeah. Yeah, you go back real quick. Yeah, so this is all approvals, whether it's 504 or not. Some of these banks are they'll be 504 lenders solely. We do 7A or 504. We'll get into the products a little bit later. Next, please. Okay, so this is an interesting slide. So that black line is occupancy. The blue is inventory, and then the gray is absorption, right? So you can clearly tell, when COVID hit, right? Right around here, the things were still being built, inventory was happening, but you couldn't fill them up. So then come out of COVID, occupancy goes up, and then we're here in 2025 almost to where, we could be in 14, 15, but it's still continuing to grow. And that's only halfway through the year. So I anticipate the black line to go a little bit higher. But all that being said, we're doing a ton of construction. I see it all over the country, upfit, everything like that. So the continued demand is going to drive more of that inventory growth. And I think things are going to kind of level out to where they were, I don't know, 8, 9 years ago on this. This is from Nick Maps Q1 2025. And now it's working. All right, so why, right? Everyone knows it. Everyone's in the room. Silver tsunami. Everything's going crazy, right? And I'm doing 25-year loans, right? So I think, okay, well, if I didn't get refied or whatever, can I get paid back? And it makes sense, right? So here we are in 2025 and 2050, we're here. 2060, we're here. That's ridiculous. It's just, it'll be, this market will be around for quite some time. Demand will be there. So owner operator stuff is going to fill the void between what the big boxes can do and where that demand is going to be. So that's good news. Then you think about, all right, new construction, or do we go get, a building and upfit it? Here are the average property ages, actual asset ages for, I think assisted living, memory care. I mean, the median is, these buildings are 20, 22, 21 years old. I like this. Well, everyone wants a new building, purpose built, all the stuff. You think about construction costs and everything today, maybe the outfit is a way to go. Come in at a pretty attractive basis, a pretty attractive price point, and then, kind of do that. So we do both. We're not scared of either one, but I just, you kind of look at some of these older buildings and then what's out there. I mean, that median number is pretty high. Bed rates. Now this is specific to Texas, or South Central Texas. You can look at, they have all the communities, right? So look at, on the left, we've got just assisted living, and sort of the average in all communities bed rate is $6,700, right? That's a little bit, I mean, it's okay. I wouldn't bat an eye to underwrite to that, or even lower than that, or higher than that, just depending on the specific market. Memory care, about $9,300. So I generally think like $7,000 assisted living rate, okay, underwrite to that, and then 10 grand memory care. Kind of start there, just because we look at so many deals. But it can be lower, it can be higher. And a lot of this, just keep in mind, is big box stuff. It's not all owner operators assisted living or smaller facilities. So just, take it for what it's worth, or with a grain of salt. Occupancy, still really high. I mean, 89% is the median for AL and memory care. That's going to be probably going to be where we expect it to be for the next few years. And even higher, really. I mean, you put a vacancy rate on anything that you underwrite, but that's the real median occupancy. These are the newest numbers. Length of stay, right? Assisted living, you're thinking, 25 months, memory care, 18, that kind of tracks. Those numbers have not changed year over year. And then you kind of think, okay, per resident FTEs, they kind of been in line since last year and the year before when I looked at the rest of this data. But that's just interesting. Occupancy is going to sort of stay where you think it is, and you're going to have those residents for that average amount of time. Revenue, you're increasing your revenue with increasing your bed rate, right? That has happened more so in more of an expedited fashion in the last 6, 8, maybe 12 months. you know, you're turning over rooms, you're increasing your, but what it hasn't done is caught up with sort of the payroll, right? That's your biggest expense, and getting down to your net operating margin, which is what we look when you're doing your numbers or your projections. That's our benchmark, and that's industry wide. But again, if it's a little bit lower, it's okay. A little bit higher, great. I've seen 40% net operating margin on some of these small ones. Good. So I would say the biggest thing is making sure that you are charging the appropriate bed rate. Right? There's always going to be some attrition. There's going to be all those things, but keep in mind, you know, a little bit here, a little bit there, it help that margin get where it needs to be.
When you talk about appropriate bed rate, are you saying charging what should be charged?
Yeah.
Just lower or higher?
Yeah, and it's if you've got competitors, right? You look at what they're charging and look at what the margins are gonna end up being, right? So, you know, you might be okay with a smaller net operating margin, right? And maybe you don't pay yourself as much. Maybe you're doing something else outside of it. But we just want to get to where it's close enough to that end. All right, this next. You hit the next slide. All right, key performance indicators. This is sort of what I was talking about a little bit earlier. So like, see how revenue went up 9% last year to this year, or last year. But payroll, that's been, there's not much you can do about it other than, you know, charge a higher bed rate. But that's our biggest expense when we look at everything for any business really is going to be your payroll. You know, it's sort of stayed steady, right? 20, 24, 25%. You know, that's with your management, and without it, 31 or 23, 29, 24, 29 and a half, 25. So it's hovering where it should be. All right, let's see next. All right, so we do a lot of construction, we do acquisition, financing, expansion, and then construction. So we have a whole construction department, manages all the draws, does everything. And it's a moving target to underwrite construction right now. So we're very conservative with it, but this is the latest, and these aren't necessarily our words, this is Nick and Asha and the comments that they make. So they think there's going to be a big labor shortage, especially in the sort of the world of, especially this state. They think that, you know, with everything cramping down, labor will go up for construction costs. That'll go up. They're just kind of hedging there. Who knows exactly what's going to happen, but you know, that's just where we are for price per square foot. Now, if you look at the assisted living price per square feet, it seems pretty hot, doesn't it? It's inflation, it's tariffs, but it's all deal specific. Go ahead, John.
Tell us what Nick and Asha.
Oh yeah, so Nick and Asha are sort of the main, you know, reports, and they have Nick maps, and they have all these kind of things where they basically measure with all these different metrics how the industry is doing. So the Nick maps is sort of the gold standard of how each market's doing throughout the whole country, and they'll get state to state. Yeah, National Investment Conference is Nick, and I forget what Asha is. I always forget it.
How are you spelling?
Yeah, so I'll.
Yeah,
But yeah, so we just kind of use them to underwrite. Nick Maps has always been part of our underwriting for each metro area, MSA, right? And so that's sort of where we get this information from. And again, like I said, this is big box stuff. It might be different for sort of smaller care homes. Smaller care homes.
So I guess it's the cost of the land included in the per square foot costs, or is that just purely the development cost?
I think it's just going to be your hard cost.
The bed is high level or the number of units?
So this would be like the low end of the quotes that they would get from your general contractor, right? So like, yeah, And then the mid-level, high level will be also like, hey, what are we building? Are we building like the Taj Mahal? Are we building purpose-built middle market? Or, right down, maybe even more affordable, right? So,
What is site work excluded? Site work excluded.
so site work. Let's see.
Bottom line.
Yeah. So site work would be moving dirt, everything. This, like we said just a bit ago, would just be for like the building. Yeah, so site work, depending where you are, could be really high or really low, right? What's under the ground, if you're building, like I had a deal in Illinois, and we got the reports, and it was just gonna cost too much to break all the rocks up and build what you wanted, so. But then, yeah, they're gonna exclude that. This is just for, just for the structure. And then, like you can see, skilled nursing is always gonna be a little higher, because, they have more to those buildings, right? Usually rehab sides, all that kind of stuff. Yeah, so tariffs, we don't know. Some of it's been affected, some of it hasn't. But overall, we underwrite to each deal. So, and it's always good to get a couple different quotes. And then we'll manage those throughout. So like, for example, if quotes come in, stuff goes up, stuff goes down, we'll be able to maybe get a loan increase or take from one bucket and the lease prices to the other. So here we go. This is Nick Maps and Asha. And this is interesting. Obviously, you all know this, but you're kind of catering to the adult child, right? And it's mostly going to be mom that's going in there, right? So, and then marital status kind of throw in there. These are kind of some unique stuff we kind of put into our underwriting and talk about with our borrowers on how they're going to market, the future risks and whatnot. Average move-in 84, right? Maybe that goes up, maybe that goes down. Who knows in the next 10 years, but that's where we see it today. And that metric off Asha from the previous slides kind of rolls into length of stay, right? So that is important, to kind of think about. It's fun stuff. The other thing we see a lot, right, will be meals and then technology. So we look at look at business plans, say, all right, what are you doing? Most of it's two meals a day, assisted living, even memory care. You see that metric. What are you serving? What are they actually like? Resident might not care, but the adult child does care. And then technology, right? As adult children are obviously more or is used to having everything on their phone, you can kind of leverage that point, put that in your business plan, whatever software you want to use. Everyone wants to know what's going on at all times. So investing in that, especially for our turnaround facilities, new management, bringing stuff like that does matter. And we do look for that in business plans, as we work through it. Care home versus big box, right? We've seen a lot of people in the market kind of steering towards the care home sort of smaller facility, which wasn't the case probably 5-10 years ago. Again, smaller, easier to do. SBA works with it. And then caregiver retention is great, right? Your caregiver is not taking care of 30 people on one floor, right? They've got 16 people. They get to know them. It's an easier life for them, easier job. And they do wear different hats, right? They're not just being a caregiver. Maybe there's some other stuff that they're doing, housekeeping, little things like that. So it kind of works, right? It makes things a little bit easier for them, or you hope that it does. And then the retention is going to be there because they're not overworked. All right, sort of back to let's get back to this. So silver lining, right? We got a little bit of a net operating margin squeeze, but I think that'll kind of catch up. Occupancy is going to be there, and then really just construction. We got to really be careful of it. We got to look at it deal by deal, and then knowing that the big box is not the only option. I think that word's kind of gotten out. So this is sort of what we do. So 7A is SBA kind of $7.5 million in debt and under. Most banks will stop at 5. We'll go up to 7.5. 10% down, generally. And, we're doing everything under the sun with that loan. I like that loan structure and that product because you can finance your working capital, your intangibles effectively. You want to do marketing, you want to do anything under the sun, you can throw it in that loan. We also do 504. 504, we do quite a bit. A lot of that are a little bit bigger deals. I just closed one in Florida for 101 beds. We did $18 million in debt on that deal. But you can only lend against the actual real estate, right? So whatever the appraisal real estate value is, you can lend about 85% to that. And if it's a startup, you're lending 80% to that. But you're not going to be able to put in working capital or any sort of intangible proceeds in those loans. So what's the answer to that? Well, we can do a third loan to do those intangibles behind the 504. So that, but most of the time we're doing 7As for this sort of segment of the market. And those are great, especially if you're an existing owner, right? Because you've got one, you've done well, you've had it over a year, maybe a year or two. Well, you want to do another one? We can do that, potentially 100% financing. So you're not going to have to come out of your pocket with any down payment. So think about that as you expand or want to buy somebody else's or whatever you want to do. The program does allow for that. Yeah, so basically stuff I get a lot of like, what do we have to put down? We try to get it to 10% for startups. Sometimes it pencils out at 10, sometimes it pencils out at 15. So, but we try to stick to what we can do with the program. Timing, right? So we do, hey, I want to do this. Generally, it's a 90-day start to finish with us. 2 weeks in underwriting, get approval. 5 to 7 in closing. We're ordering appraisals, third-party reports, title work, you name it. And then we've got some of these where you have a residential seller. In certain cases, they're used to a 30-day close. This is a commercial loan, right? We're underwriting a business, so that's a big hurdle, right? If you have a residential seller, they're just going to have to deal with it. Now, there are a couple ways you can get around it. If you really want that property, you can go get a residential mortgage and get it off the market. If you do that, remember, we can't refinance those if they're longer terms than the SBA allows. So the SBA allows 25. So whatever you do on your residential thing, you get off the market, make sure it's 10 years, 15 years, whatever it is. And that way, any SBA lender can refi it and be in first position. So that's one way, or you do like a hard money loan and we'll refi that. That's another way to do it. But if you get a seller that can wait, then you don't have to do 2 closings. But that's ideal. So yeah, so this is my email. We have the website stuff, but I would reach out through the email first because sometimes we get lost in all that kind of stuff.
Why wouldn't I just do a residential loan on a residential?
So there's 2 reasons why you wouldn't do it. The first is, you're not going to be able to get your working capital and all these other things that you want to do, right? With a residential loan, it's not going to do all that to help with hiring people, marketing, doing all that kind of stuff. Second thing is, most banks want to be in first position on the facility, right? So it doesn't stop any bank from being in second. The program still allows you to lend to that. But the lender itself, the bank itself is like, we want to be in first position. We're not going to sit behind a residential lender. And then the other thing, if you have a residential loan, a lot of those loans, if you're operating a business out of that house, you're going to be in default on that loan. So those are the reasons why you kind of want to go with commercial loan. The other reason is, we're underwriting the commercial loan to make the business successful, right? We're ordering the appraisals from appraisers that know the business. We're doing all that work. We've done all this stuff, portfolio analytics, performance. You go see the deal. We have construction. None of that is going to happen in a residential loan. You're going to be on your own. And, people do it. Some residential lenders are okay with it. Most aren't. But the safe way and the right way to do it, I think, is through a commercial loan with folks that understand the industry. And that's where we play. All right. So any other questions? Sure.
So say I'm like a new developer, right? Like a startup, I'm a new developer and I want to build on some land, ground up construction. You go through the steps that you think would be best for someone in that scenario. Because I think the biggest risk a lot of people run into is them getting that bridge loan on a piece of property and then not more about that?
Yeah, so the scenario here is you've got this raw land, you want to develop it, you finance the raw land with a bridge loan. Maybe you get an SBA, maybe you don't. Happens. So what I think would be the easiest path would be, look, let's just do it all in the SBA loan. Remember, SBA is all one loan. There's not like a bridge or construction loan to a perm. It's all one loan. So you know you're approved, you know you got your pro forma, all the funds are there, and you build it, and you don't have to refi. You build it, and you go right into operating it and having the same loan payment and the same loan the whole time. What that does is saves you on closing costs. It's a hell of a lot easier knowing that you're going to get that money for 25 years, right? And you know that you don't have to go run around and try to find someone to refinance your bridge, right? So that's a big bonus for the SBA. Now, we do offer conventional financing and bridge to HUD, but those are going to be for big box facilities. It doesn't really fit this. And then again, like banks are really tentative right now. Like the leverage points, the down payments and all that are still really high on conventional senior housing debt. And so you get kind of the best of both worlds. Don't have to worry about construction and perm, and you're only putting 10% or so down. You're doing a regular loan, you're going to have that construction that you have to worry about bridging out, and you're putting 40% down, 35 to 40% down, easy today. So that's why SBA is really popular. Keep money in your pocket, worry about the business, and don't worry about the loan.
I have two questions. You said you underwrite to 30% net operating margin. Is that in what year? If it's a startup, you know, the film, is it the first year or is it the fourth year?
Yeah, so the idea is if you're doing a startup, we're going to be underwriting on a projection-based situation. And when we do that, we're going to do your construction probably going to be a year and a half, maybe. We look at post-construction pro forma. So, hey, I'm going to be open this day, and I'm in Texas, so I can get 3 residents or whatever until TDOT lets me fill out the rest, build that in. And usually by year 2 post-construction, we want to see a debt service coverage ratio of at least 1.25 times and a net operating margin there by end of year 2. And in year 3, you should be coasting.
Okay.
Yeah, it's just projection-based versus historical-based financial analysis.
Okay. And the second question is on post-closing liquidity. How much do you normally have to have? And what type of liquidity is it? Could it be, if I had an investor and they had it in their account, non-retirement, but they just have it, could that be used even in a non-personal guarantee?
So the idea with post-injection liquidity is going to be specific to your particular credit report, right? So if you don't owe a lot, and you know, most banks will say, all right, 6 months of payments. I want to see 6 months of payments that you have post your down payment. That's the usual rule of thumb. Does that count with retirement? Maybe. You know, it depends. I wouldn't count retirement. I don't want to touch retirement. I want to have cash for you to cover yourself for 6 months in payments, right? So that's how I underwrite it. Some people don't. Some other lenders won't. Maybe they say it's okay to liquidate your time. I don't like to touch that. I'd rather underwrite the deal specifically where we feel comfortable. And then the non-guarantor side of things, you want somebody to sign on the loan if you're relying on their liquidity. If I'm relying on you as a guarantor, you know, that's what matters, right? If they don't guarantee the loan, there's really nothing I can do. Or if they don't want to guarantee, have them write you a check. Say, hey, 6 months of payments, here's a gift letter. Okay, check that out. We had another question. Sir.
So if I'm being able to buy a property from the market, would you walk us through your due diligence in, you want to let me say any price, right? How would you evaluate that property? Is it by the doors or cost per door, cost per bed, or is it by the EBITDA they're doing, what's their financial health is like?
Yeah. So the question is how we look at valuing or pricing or whatnot. So we're a bank, right? So as a bank, I'm not gonna be able to tell you what the value of what you should be paying or whatever, because that goes into lender liability. And so what we end up doing is I'll do cash flow, whether it's a startup, acquisition, see if it all makes sense. And I'll say, hey, look, this is what I can lend on this particular deal. You can kind of back into what you want to pay based off that. The negotiation is going to be between you and the seller, right? And then I'll do the work on the debt side. You can back into what your value probably is going to be. But what it's going to actually, what we're going to actually end up having, and every lender that's insured is going to have this, we'll get the commercial appraisal to substantiate our underwriting, and they will give you the value. And we have a list of probably 8 sort of national appraisers that have specific senior housing teams, right? We know them, but what I can't do as a bank, I have to go through a management company because I can't know who the appraiser is going to be, right? That happened after Dodd-Frank. You know, you used to be able to say, I want to go with this guy, he's going to get a value, but that's not the case anymore. But with Live Oak, we do have a qualified list, people that know what they're doing, and then you all pick the bids. We get 4 or 5 bids, usually get the cheapest, fastest one, and we can do that before we underwrite. We can do that after you're approved. I like to get them early, right? Because if there's if you got a high value, great, and you have a lower price, don't share it with the seller. Comes in low, share that appraisal with the seller, be like, wait, we need to maybe think about something else. I don't get in the middle of that. I'm just the debt.
Just follow up, maybe that's another way. If you have a view based on what you've seen, are these being, the properties in the market are being valued by the room floors, or are they being valued by the money getting?
Yeah, so there's 3 different values that we look at. Now, they'll go door by door, bed by bed, whatever it is, but it all comes out to be a figure. So when we get appraisals, the value that we'll see is an as is, as complete, if you're doing any kind of upfit, and then there'll be a going concern value, right? So the as is, basically what the real estate is without the business. Going concern will incorporate the business, the market, competitors, the rates in that market, and they'll come out to be like, okay, it's worth $7 million, as it is $5 million, but with the business, $6 million, $7 million, right? So it'll all be broken out. So look at every single metric. But for me, on the front end, I'm just looking at cash flow. Does the deal meet the debt service and does this make sense? And then I look at so many deals. So you kind of can feel like, okay, I get it. I can kind of see where this is going to work, or maybe that you're paying too much. Now, what I've also seen is values have gone down this year, right? Everything was going up, and now things are kind of normalizing and going down. And the rates are going to come down. They already have. Wall Street Journal Prime, we base a lot of SBA. Our index went from 7 to 7.25. We think that's going to continue to drop, which will also help with our net operating margin, the payroll, everything. So that is a little bit of a light at the end of the tunnel for everyone. Just ma'am.
You ever have this scenario where somebody uses private lenders for the construction and then refinance with you? And if the case, could they do it after the construction, or would they have to wait like 2 years of operating?
Yeah, that's a good question. The idea, every bank, every lender, they want to manage the construction and make sure it's done correctly, right? Yeah, we have inspections come in before we pay and do the draws and all that. It's really important to have that. Now, if we are coming in mid or right after construction, we'll get the inspections and we'll try to, but we're looking at it as a startup too, right? So, I always would say you're better off going with us or another bank to start with that, because you get all those safety mechanisms, but it's okay. If it makes sense, we'll do it. I had a deal in Virginia that we had a builder who wasn't as familiar with the requirements from the state for memory care. He was fine with assisted living, but we underwrote the deal as a memory care. And then the state came in and none of it worked. They had to spend another $500,000 to redo the building. So you run into those cases sometimes when you have builders that aren't as vetted. We vet every single builder, general contractor, that we do deals with, right? So we underwrite them as well. So just little things to think.
And do you still require, if somebody owns real estate outside of this, do you have, you put liens on those properties as profitable?
That's a great question. So when we look at collateral, there's the subject. And as long as the subject property as complete or whatever it is, secures the loan, then we're not going to go out and look at taking liens on other properties. That's just Live Oak Bank. But if you go to a different bank, they may say, hey, we want that rental house, or we want to take a second lien on your personal residence. It's up to the bank, right? But we do so many deals and we're nationwide. We're okay with just the subject property. I don't really care about taking a second lien position on someone's vacation home. I'm not going to get anything out of it. But other lenders have to check boxes on their credit policies. So yeah, I would shop banks if you don't want to do additional collateral, or they may, open up an account. There's all these different ways to negotiate a deal. You just hope you're in that position where, and most of the time, these appraisals come in and secure the loan, and you don't have to reach. And
Look for a homestead.
yeah, and that's right. So Texas is a homestead state, but it doesn't stop a bank from asking for it. So you can still take a lien. And you knew that you're in a homestead state, and they say, no, we don't want the additional route. Well, the bank just says, all right, well, we're out the deal. Right? I can't force in Texas to do that, but I can say no to you.
So can you use, the collateral to do the 10-20% down?
So that I get that question a lot. So we need cash to close it. So a lot of people will take out a home equity line of credit and use that as their down payment. But in order to do that, you have to show outside source of repayment to your home equity line of credit, right? It has to be true equity to the deal. It can't be, robbing Peter to pay Paul. Right?
I mean, if you have a property that you can use as down payment, right, use that to be your down payment, but you have equity cash. To do closing costs. and all
Yeah.
that.
So you're essentially the equity in that real estate will have to come into the deal as cash. So you're going to be pulling that equity out on the equity line, putting it in an account, and putting it down, a down payment on the settlement statement.
You guys also offer Fannie Freddie product and also, you said grid to high, but you guys do that as well, or?
Yeah, so we are not a HUD lender in Fannie Freddie. So that's agency lending in a nutshell. That's my background before Live Oak. But HUD, you have to have a certain profile for the facility to be HUD eligible, right? Certain number of bathrooms per thing. I mean, it's like a whole nother level of complexity and requirements to be able to do that. In the big box world, the ultimate place to be is a HUD loan, right? That's where everybody in senior housing wants to be. And the reason for it is it's a low rate for 27 to 30 years, and there's no recourse, right? Every SBA loan and most of your conventional loans are going to have recourse components. What
What are the loan limits on that? Minimum, maximum?
on HUD? I mean, you could do one for, I've seen as low as 5 million up to 60 million. I mean, like, they're.
And what's the fee structure and timeline look like?
Yeah, so HUD, a lot of times what will happen is you have to season the property, right? If it's existing, these are all existing properties that have performance, right? So you would have to be seasoning those for 2 years, right? So that would mean you're having a high level of income and production and sort of you're showing the
You
HUD.
gotta be making money on
You have to be making money consistently for 2 years to go to HUD. But none of these care homes are going to be HUD eligible. So it's sort of like, but that's the world that the bigger sort of facilities are
it.
in.
Why not?
Well, they don't have like, every room needs a bathroom. Everything needs this, like, it's like a whole slew of things. You're really, when they're trying to lend in the HUD world, you're lending to that big box sort of, what you think of when you think of a big box assisted living or memory care. And the same thing as Fannie and Freddie. They can do those loans as well. They're just not as attractive as the loan or the HUD loan on term. Again, that's not really applicable to these. But one day maybe they will, right? The more and more of these that come up, you might have HUD change the rules and let them in, but right now it's SBA or conventional.
So recently, there's been a sort of a failure of a large operator in the North Dallas area. Does that have any impact on your guys' credit appetite in this area?
No, you know, we see the overall demand as the more important weight, right? So like, if you had an operator that failed and there's still demand in the market, well, I would believe that you can right those wrongs and manage a property to fill it up. We're really bullish on the sector, right? And again, like, you don't know where it went wrong. You'd have to get into there. It's already shut down. So really, you're just looking at it as a startup, right? There are a few in this state where there's a portfolio of ones that didn't do as well, or they try to grow too fast. But it's not because of demand. It's because the deals aren't underwritten correctly and the management was not up to par. They didn't try to fill them. They didn't market the right way. You know, they didn't structure their investment responsibly.
Are you guys underwriting the deals any different because of Liberation Day and all these tariffs, certainty around tariff right now? I know my person, I know in the past, it was like 10% construction contingency, construction contingency because of that, or not been impacted?
So tariffs are a moving target, and 10% of hard cost is bottom line. If we can add some more, we feel good about it, we will. What we also do is we'll put a lot of cushion and stress on our numbers, right? So you might have a couple 100,000 more in working capital than you wanted to borrow, you know, just to be safe, right? And you're getting caught, like, costs are going to, these tariffs and whatever are going to be reflected in your construction bids, right? And so once you have assigned hard bids and everything, that's the number. Well, we're gonna review every single number and we're gonna say, maybe this doesn't make sense. Maybe we have to phase this or whatever. You know, I look at deals that we do in Alaska before tariffs and everything, and those deals, the construction costs they go like this. And so I use those deals as sort of an analytical backstop to the lower 48. If things went horribly wrong, right? Like they did in these deals, we still have enough cushion in the cash flow to get them right. And they're doing great now. But, you know, those are the ways we think about it. But again, you know, no one really knows. But we know there's demand. We know we're going to be very, very vigilant on the construction budget. We know we're going to look at every draw. The construction team works at 4 below me. I'm down there all the time. So that's the value you get with a lender that runs everything in-house. We're not farming it out to another place. We got the thumb on the pulse of what these construction deals are doing. But again, it does not slow us down. We've done more deals this year than we've ever done, and the portfolio is doing great. Okay. Yeah, the question was, how long do you guys kind of see it filling up? Yeah, I would say it's going to take, you know, in Texas, it takes a little bit longer than most states because of the licensure requirements. So I would say give you kind of the first year to kind of get it. And then year 2, we really want to see it flying. So when we built that all in. So the first year, because of licensure for Texas, most town will say 8 months, but I think for Texas, I kind of rounded out to a year post construction. Yeah. Because it's going to take a while. You know, you're going to have to go out. You're new to the market. People got to get comfortable with you all. You know, get someone in there. So we build a lot of time. All right. Coming up on that hour. We have 5 more minutes. Any other questions? Great. Yeah, shoot me some email. We got a great team, and we're happy to keep growing. Happy to be here, and And if you guys are welcome to the slides, John, if you want to send everybody out these slides, some of these metrics, American Senior Housing Association, and then Nick, are we're pulling a lot of this from Texas, 6,700, 9,300. Here and there, get what you can get. And, yeah, if you have any questions, we're all ready to go. We can size up loans, do pre-approvals, pre-qualifications, what we call them. And, go from there. Thank you all for your time.
Thank you. So a lot of the data that you saw from Asha and from Nick are very expensive subscription services that are specific to senior housing. And so as you're considering a lender or you're working with your lender, ask them for this type of data, this current data as you're going through it. Your lender, if they subscribe, should be able to just kick out a whole bunch of information to you that will help you with your business planning. If they don't subscribe, that tells you they don't do a whole lot of senior lending. So